Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. If you like our content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. In this video, we'll be talking about 5 stocks which ICICI Direct is betting on as portfolio picks. Now the first stock on the list is Grindwell Not Unlimited, which is available at Rs 535.20 and the face value for it is 5. The symbol for it is GRINDWELL. Now Grindwell Not Unlimited is a holding company which manufactures abrasives. The company's segments include abrasives and ceramics, also plastics. The 1-year chart reveals that this company was on an uptrend for about a quarter or so, but since then has largely been consolidating. What's important, however, to note here is that irrespective of the carnage in the markets, the stock has not really corrected much. The company is a mid-cap with a market capitalization of 5,925.73, and this company reported a robust Q1 FY19 wherein revenues, EBITDA and PAT grew 12.5%, 33.5% and 45.1% respectively. This was mostly on account of strong growth of 12.5% year-on-year and 29.4% year-on-year in the ceramics and other segments respectively. These segments also reported strong EBIT margins of 17.1% and 24.5% respectively. Going forward, ICICI Direct expects all the 3 segments, which are abrasives, cement and others, to grow at a healthy CAGR of 11.2%, 17% and 23.5% over the period FY18 to 20. Accordingly, they expect Grindwell Not Unlimited to post healthy top line, EBITDA and bottom line growth of 15.1%, 13.1% and 13.8% respectively. Additionally, with a cash balance of Rs 272 crores and debt-free status, they believe that Grindwell Not Unlimited is a quality play. Now looking at the financials, the company is available at a price to earnings ratio of 36.94, which is much cheaper when compared with the industry price to earnings ratio of 43.82. The book value of 88.77, however, translates into an expensive price to book ratio of 6.03. The 52-week high for the stock stands at 588.80, whereas the 52-week low for the company stands at 392. Now the second stock on the list is Heidelberg Cement India Limited, which is available at Rs 165.95 and the face value here is 10. The symbol for it is HEIDELBERG. Now, Heidelberg Cement India Limited is engaged in the manufacturing of Portland cement. The company's product portfolio includes Portland Pozzolana cement and Portland slag cement. The company's manufacturing facilities are located in Karnataka, Madhya Pradesh and Uttar Pradesh. Heidelberg Cement has a total cement manufacturing capacity of 5.4 million tons per annum. Now, as is evident from the 1-year chart, the company has been haphazard in its movement for the entire year. The market cap of the company is 3,760.64 crores, which means that the company is a mid-cap one. In Q1 FY19, the company reported strong volume growth of 15% and EBITDA per ton in excess of Rs 900 per ton, indicating a robust improvement in industry dynamics in the company's area of operation. Going forward, a pickup in construction activity, better sand availability, normal monsoons and a hike in minimum support prices is expected to keep demand healthy. In addition, operating leverage benefit and cost efficiency are expected to result in margin expansion of 90 basis points to 18.9% by FY20. Now, as is evident from the financials of the company, the EPS of 7.42 translates into a very cheap price to earnings ratio of 22.37 when compared with the industry price to earnings ratio of 40.75. The book value of 46.18 also translates into a reasonable price to book ratio of 3.59. The company has a dividend yield of 1.51, whereas the promoter holding is also a good number at 69.39%. The 52-week high stands at 189.95, whereas the 52-week low for the company is 116.60. The third stock on the list is ITC Limited, which is available at Rs 319.85 and the face value for it is 1. The symbol for it is ITC. Now, ITC Limited is a holding company which is engaged in the manufacturing of fast-moving consumer goods. The company operates through 4 segments, which are FMCG, hotels, paper boards, paper and packaging, and agribusiness. Now, as is evident from the 1-year chart, the company was doing nothing for about 3 quarters into the year, but since then has been on a huge spike. The market cap of the company is 3,91,219.48 crores, which means that the company is a mega cap one. Now, ITC reported a strong set of Q1 FY19 numbers wherein revenue, EBITDA and PAT increased 7.6%, 12.2% and 10.1% respectively. Its cigarette segment volume growth was close to 2%. This was a surprise as the respective segment has been degrowing in the last 5 years. ICICI Direct believes that volume should grow 3% in FY19 and FY20. Given expected stable cigarette volume along with stronger profitability in FMCG business, they expect revenue and earnings to grow at a CAGR of 10% and 11.6% respectively. Now to take a look at the financials, the EPS of 9.39 translates into a price to earnings ratio of 34.06, which is largely in line with the industry PE of 34.59. The book value of 42.03 however translates into an expensive price to book ratio of 7.61. The dividend yield here is 1.61%, whereas the erstwhile promoters of the company do not hold any stake. The 52-week high for the stock stands at 322.60, whereas the 52-week low is 250. Now the fourth stock on the list is STRTECH Technologies Limited, which is available at Rs 362.65 and the face value for it is 2. The symbol for it is STRTECH. Now STRTECH Technologies Limited is a global technology company engaged in designing, building and managing smarter digital networks. The company's projects include intrusion-proof smarter data network for the armed forces, rural broadband for BharatNet, smart cities development and establishing high-speed fiber to the home networks. Now, as is evident from the 1-year chart, the company was on an uptrend for the first quarter or so, then went on a decline, but of late it has again recovered. The market cap of the company is 14,564.08 crores, which means the company is a mid-cap one. Now, STRTECH Technologies remains a quasi-play on rising data demand globally and subsequent need for deep fiberization of networks. Being an integrated player, it is poised to reap the superior benefits of operating leverage already seen over the last couple of quarters. ICICI Direct foresees a robust growth potential ahead with top line and earnings CAGR of 34.6 and 38.1% respectively between the period FY18 to 20. Now to take a look at the financials of the company, the EPS of 7.94 translates into an expensive price to earnings ratio of 45.67, which is much more expensive when compared with the industry PE of 33.23. The book value of 26.65 translates into a price to book ratio of 13.61, which is also on the higher side. The company has a dividend yield of 0.55%, whereas the promoter holding is just about average at 53.96%. The 52-week high is 415, whereas the 52-week low for the stock stands at a figure of 212.65. Now the final stock on the list is Sun Pharmaceutical Industries Limited, which is available at Rs 652.85 and the face value for it is 1. The symbol for it is SUNPHARMA. Now Sun Pharmaceutical Industries Limited is a pharmaceuticals company. The company's business segment includes US business, Indian branded generic business, emerging markets, global consumer healthcare business and active pharmaceutical ingredients. Now, as is evident from the 1-year chart, the company was consolidating for the first few months of the year, then went on a decline, but of late it has again recovered in value. Now this stock is greatly benefited by the rise in dollar. For Sun Pharma, Q1 FY19 results were above estimates despite lower than expected taro sales. Going ahead, focus on specialty products in the US is the culmination of the management's endeavor for a shift from generics in the backdrop of US headwinds. The management has reiterated double-digit growth guidance for FY19 with a slew of specialty launches besides Halol decongestion. Now looking at the financials shows that this company has an EPS of 15.95, which translates into a price to earnings ratio of 40.90, which is much more expensive when compared with the industry PE of 32.18. The book value of 158.7979 translates into an expensive price to book ratio of 4.1112. The dividend yield here is 0.31, whereas the promoter holding for this stock stands at an above average figure of 54.38. The 52-week high is 659.40, whereas the 52-week low for the stock stands at a figure of 435. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. This and all other content that you see on our channel is intended to be a piece of news. Also, we'll be providing the link to the source article for this video in the description section. Please go through the article to build more conviction around your investment decision. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.